So yeah, we're gonna go into stocks. And so first, we're gonna play a little game. It's called Would You Invest? It's pretty easy. I'm gonna show you guys a business, and then you tell me if you would invest in them. By that, I mean, would you give money to help support their company? Oh, and then think about why. First we have is Nike. Would you or would you not invest? And you can do like the raise your hand thing, just do like a thumbs up. Yes, okay. All right. Oh, an accent. All right, second one is Starbucks. Would you or would you not invest? No, he says no. Julie says yes. All right. And then we have Apple. Would you or would you not invest? Yes. Okay. Right. Okay. Oh, there's supposed to be four. Okay. Well, anyways, so for those questions, the reason why I ask you those is because that's what a lot of investors have to do literally every day, or that's what people who invest do to make a living. They have to decide, am I going to support a certain company or not? And so by supporting them, investing, you're buying a stock, which is a share of ownership of a company. And so those are usually publicly funded companies. For example, you can buy stocks from Apple, like a piece of their company. It's just the price of it was always going to fluctuate. And then the stock market is just where people buy and sell stocks. Now, the stock market, if you know Wall Street, like that famous place in New York, it's literally just like one big place where a lot of brokerage companies, which work with stocks, all like rent out spaces. And so let's go into a little bit more about that. So the stock market, it's where publicly traded businesses sell stocks or part ownership of their company in order to raise funds for growth. So if I buy a stock for a company, I'm giving money for them to grow, and I do it for the purpose of gaining money. So people or groups buy stock to invest and gain returns through brokerage firms or other means. So they go through a second party, or sometimes you have I want to say like you have like technology help that can help you decide what to invest in. And through there, you'll give money for a part ownership, and you can sell your stock if you want to, if it makes more money, or you can wait until it reaches a higher price. Now, the price of your stock, or like the worth or value of what you own, really depends on a lot of different things. And I'm going to use the example of Starbucks in a second. All right. So the stock price. Every ownership of a company depends on some certain factors. You have like economically, what is the state of the um country they're in, like economics, also inflation. It all can either make or break a company's stock or how they're doing. You also have company performance. So how much earnings are they getting? Are they making more money this year? Or are they not? And then market news, if there's positive or negative news surrounding their like area of business. There's also just like industry trends. If let's say like the phone book industry, not people don't really use phone books anymore, so that would be a company that you probably wouldn't want to invest in, and that they probably have like a low stock price just because of that. And then you have global events, so war, geopolitical events, etc. And the reason why I brought up Starbucks is that, like, for example, this would be an example of, I guess, you could call it like company performance or even just market news. Starbucks went through a lot of controversy through like indirectly supporting Israel in the Israel-Palestine conflict. And so that led to a significant drop in their sales, which might definitely a lot of investors or people that have bought stock from their company used it as an indicator of whether or not they should keep their stock or sell it.